For nearly a century, the world has treated the US dollar as untouchable, the symbol of financial power, the anchor of global trade, and the ultimate safe haven. But our team's latest analysis reveals something few Americans are ready to hear. The dollar's era of absolute dominance may be ending, and the plan to replace it is already underway. This isn't speculation. It's a coordinated economic realignment playing out quietly across the globe, one that could redefine what your savings, your retirement account, and even your paycheck are worth. Behind the public headlines of inflation, interest rate sheets, and economic recovery, another conversation is happening, one that central banks, sovereign wealth funds, and world leaders are conducting behind closed doors. Our investigation uncovered a pattern. Nations once dependent on the dollar are quietly building escape routes from it. This isn't a random event, it's a global strategy. The story begins with a single system that made the dollar king, the petrodollar. After World War II, oil became the lifeblood of the global economy, and the US made sure it was traded only in dollars. This meant that every country buying oil, from Japan to Germany to Brazil, needed US dollars to pay for it. That demand created the illusion of eternal strength. The world's thirst for energy was the world's demand for dollars. But according to multiple financial intelligence reports reviewed by our team, that foundation began to crack in 2024. In a series of confidential energy trade agreements, several major producers, including members of OPEC+, reportedly agreed to accept payment in alternative currencies and even digital assets. One Middle Eastern minister described it as a diversification of settlement, but the meaning was clear. Oil was no longer exclusively tied to the US dollar. For decades, the petrodollar acted as a global umbilical cord, pumping demand into American assets. Now that cord is being cut. And once global oil can be priced in multiple currencies, the demand for dollars, the very engine of its stability, begins to fall. This is the hidden turning point almost no mainstream outlet is discussing. Our data analysis suggests that this single shift could remove as much as 20% of foreign demand for US Treasury bonds within 5 years, a loss so large it could shake the foundation of America's borrowing power. But the real twist comes next, because the move away from the dollar isn't just about oil. It's about control of the future, digital money. Across Asia, the Middle East, and parts of Africa, an alliance of emerging economies, often referred to as the BRICS Plus nations, is developing a new network of central bank digital currencies, or CBDCs. Unlike Bitcoin or decentralized crypto, these digital currencies are fully controlled by their issuing governments. They can be tracked, frozen, or redirected instantly. Reports from global monetary forums suggest these CBDCs are being linked through a system of cross-border payment channels that bypass Western institutions entirely. That means transactions between, say, China and Saudi Arabia could be settled directly. No SWIFT network, no dollar clearing, no Federal Reserve oversight. To most people, that sounds like distant economic theory. But for investors, it's a seismic shift. When international trade can occur without using US dollars, the currency loses its special status as the middleman of the world. And with less global demand, its value at home begins to erode, slowly, silently, and permanently. Some analysts call this the digital Iron Curtain, a parallel financial world being built brick by brick while the West watches. Once completed, it could leave the dollar outside the walls of the fastest-growing markets on Earth. The signs are already visible. Since early 2023, the share of global reserves held in dollars has dropped to its lowest level in decades. Central banks from Asia to Latin America are buying gold at record rates, a move experts interpret as a hedge against a declining dollar. Even longtime allies are quietly exploring digital settlement systems that do not depend on Washington. But what does this mean for you, for ordinary citizens in the US, Canada, or Europe? It means the value of your cash savings, your salary, and your retirement portfolio is being diluted in real time. Inflation is not just a domestic issue, it's the visible symptom of global de-dollarization. When fewer countries hold or trade in dollars, the currency's strength weakens and prices at home rise to compensate. Groceries, rent, fuel, everything costs more, not because of shortages, but because the dollar quietly buys less. Our analysts describe this as the silent tax. Unlike traditional taxes, it doesn't appear on a pay stub. It appears at the gas pump, at the grocery store, and in your mortgage rate. It's the invisible erosion of purchasing power, and it's accelerating. The danger isn't just inflation, it's dependency. Most Western citizens now keep nearly all their wealth inside digital banking systems tied to the dollar. If that system loses global relevance, your savings are not just losing value, they're losing influence. This is why our investigation shifts focus from the problem to the defense. If the dollar is weakening, what assets remain strong when confidence collapses? History provides the first answer: precious metals. Gold and silver have outlasted every currency in history. They carry no counterparty risk, no central authority, and no expiration date. Reports from major asset managers show that even small allocations to physical gold can offset significant losses during currency declines. The second defense is diversification outside the Western banking grid. That doesn't mean evasion, it means strategic allocation. International ETFs, emerging market commodities, and even regulated foreign accounts can serve as ballast when the domestic system wobbles. Our analysts stress that spreading exposure across different monetary zones can dramatically reduce risk if a single currency falters. And the third defense is productivity, investing in assets that generate revenue faster than inflation eats it. That could be real-world businesses, dividend-paying stocks, or even digital infrastructure projects that thrive regardless of currency denomination. The principle is simple. When the money loses value, own something that creates more of it. But there's a deeper layer, one few discuss publicly. According to several monetary policy insiders, central banks may view moderate inflation as a tool rather than a threat. Inflation quietly reduces government debt burdens while eroding personal savings. It's the unseen transfer of wealth from individuals to institutions. So while headlines focus on consumer prices, the real question is structural. Are we witnessing the deliberate re-engineering of the global financial order, a managed decline of the dollar to make way for a new digital reserve standard? Our analysis suggests it's not impossible. The pattern aligns with historical currency transitions. The pound sterling's fall after World War II, the shift from gold to paper in the 1970s, and now, potentially, the move from paper to programmable money. If so, the collapse won't happen overnight. It will unfold as a series of controlled steps, trade agreements, digital settlements, gradual de-dollarization, until one day, the world wakes up realizing the dollar is just another currency, not the currency. When that moment arrives, those holding only cash will find themselves on the wrong side of the equation. Their savings will buy less. Their debt will cost more. And the economic power once centered in Washington will be redistributed to digital platforms beyond its reach. But it's not all doom. Awareness is leverage. Knowing how the game is being redesigned lets you act before the rules change. Our team recommends 3 immediate actions. First, build tangible value. Allocate part of your portfolio into physical assets, metals, real estate, or other finite resources. Tangibility resists digital manipulation. Second, build cross-system resilience. Don't let all your wealth depend on one currency or one banking jurisdiction. Even small, legally diversified positions overseas can provide safety. And third, invest in velocity assets. Businesses, royalties, and inflation-resistant investments that keep earning regardless of monetary policy. This is not financial advice, it's strategic awareness. Our investigation concludes that the question is no longer if the dollar loses dominance, but how quickly. The collapse will look less like an explosion and more like erosion. Slow, steady, and irreversible. By the time it's official, the winners will already have moved their wealth to safety. For nearly a century, the dollar stood for strength, predictability, and trust. But the pillars that held it up, the petrodollar, global demand, and monopoly over payments, are all weakening at once. The financial system that replaced gold with promises is now being replaced by code. The new era of money has begun, programmable, trackable, and global. Those who adapt will survive it. Those who don't will watch their savings fade quietly into history. Our mission at the Hidden Wealth File is to uncover these shifts before they hit the headlines, to reveal how power truly moves in global finance and how ordinary people can protect what they've earned. If you found this investigation valuable, don't just scroll away. Knowledge is your last free asset. Subscribe to the Hidden Wealth File, share this video, and explore the links below for resources on asset protection and independent wealth strategies. The world is entering a new monetary chapter, one written in algorithms, not ink. And whether you win or lose in it depends on one choice. Will you prepare now or after it's too late?